I mean, this is a big part of what I do. So, and I don't know if a lot of people understand how the different interest rates work. So there's interest rates at a period of time, but they're for a period going out. So the Federal Reserve sets your interest rates, overnight rates that banks charge each other. And they have pushed those up 500% in the last 2.5 years. But the longer end of the curve has stayed shorter. So now, like, typically we would have a steeper yield curve. So you would have a short-term rates would be 2%, longer term rates would be 4 or 5%. And the expectation is longer term rates are higher because there's more risk. What the market is pricing now is we have this inverted curve where short-term rates are high, but the 5 years less than that, the 10 years less than that. And it's because the expectation of the market, which the Fed doesn't directly control, is at some point the Fed's going to start cutting rates. So the expectation is if you think of like a 2-year rate versus a 1-year rate, a 2-year rate is really encompasses the 1-year rate, and then it's an anticipation of the second year of what rates are going to be. If you could average those together, that would be your 2-year rate. And I spend a lot of time on our forward curve on all the hedging that we do. What we're seeing in the last 6 months is the market's finally starting to give up and say, I don't know if you've heard this phrase, but higher for longer, that the Fed's not going to cut rates next year. Like the market has been pricing, probably for the last year and a half, that the Fed's going to raise rates to 5%, 5.5%. And then 6 months from now, they're going to cut it 75 basis points and get back down in the fours, or cut it 150 basis points, get back in the low fours. And that just kept pushing forward as time went by. Now the market is saying, hey, the Fed's probably not cutting next year, and we're going to keep rates at 5%. So that has a rippling effect through all those other rates that you mentioned. So now, if you look at an interest rate curve today, the 2-year and the 1-year are very flat, and the 5-year and the 10-year are starting to creep up. And we're hitting the highest rates we've seen in 17, 18 years on most of these benchmark indexes. So people didn't want to get a 10-year loan 6 months ago or a year ago because they thought, oh, the rates are going to come back down. I don't want to pay long money, because they got spoiled with their 4% interest rate. But now they're looking a little bit smarter, because those rates that they got, if they got a loan and the spread was the same 6-8 months ago, and they want to get that same loan today, it's probably 1%, close to 1% higher. Nobody has the answer of where the Fed's going to go, where the market's going to go, but at least the market is pricing today that we're in this higher interest rate environment for the next year and a half. And I actually pulled a forward curve this morning for an internal meeting, and you can't get a rate below 4% on the forward curve right now for the next 10 years or so. So it's just how quickly the market adjusts to what future policy is going to be, what the market's going to be.